Okay, hi guys. I'm going to jump into chapter 4. Now, I'm not going to finish chapter 4. There's a lot of it, and I think it'll just be what I would like you to do though, please, is to read through chapter 4, and then I'm going to do it in class, but I want us to do a lot of questions on chapter 4. So if you can read through it, but I'm going to start it and just kind of give you a heads up on what's going on. And it's all really just because of time. Right. So we're still really talking about the individual. And in this case, we're just honing in or focusing a bit more on an individual's employment income. And the truth is, for most people, this is pretty standard. It's just really their salaries, if you like. When I say their salaries, I mean their gross wages. And then, of course, we deduct, they may deduct pension funds that they are saving for the future, and national insurance will come off. And then they pay, well, when I say, they'll deduct their pension funds. If there are any gift aids that they give by their payroll, that will happen as well. And then you will get national insurance and income tax charged. But you do have, first of all, there's this first issue of what is the meaning of being employed. This question of employment versus self-employment. And again, I'm sure you can understand the control someone who is self-employed has over the determination of their taxes, because they fill out their own self-assessment return. And so I think that what the government have done, or what the government are trying to do, is to prevent, if you like, people declaring themselves to be self-employed, to enable, or who are trying to avoid paying their taxes. So there are a couple of things that the government will look at to decide whether or not someone is employed or self-employed. First of all, when we talk about employment, we're talking about the employment of services, as opposed to self-employment, which is the employment for services. I mean, what does this really mean? If your employer gives you, if there's an obligation by your employer to give you work, and there's an obligation by you to do, I put employee here, for the individual to do the work, we say you're employed. If the employee controls the work, you're employed. If they give you sick pay and then holiday pay, you are employed. If you don't provide your own equipment, if you can't hire other people to help you. So for example, you can't say, well, I'm not here, I'm going to send someone else in. If you could do that at work and say, I'm not going to come in today, I'm going to send someone else in, you are self-employed. But otherwise, if you can't do that, you are employed. And what you do is a major part of the process at work, not just the bit. You have to be there. And finally, the fact that the financial risk is missing, in that the risk that you can just not, you can just walk out and not receive money from this person, or from this employer again, is missing, then you probably are employed. If you are dependent on that source of income, on that contract, or whatever it is you're doing as a source of income, then you are considered to be employed. And generally, when we talk about employment income, we're really meaning, this is, again, like I said, for most people, it does tend to be just the salary. But most people will receive a bonus. I'll talk about that right now in a second. And then really where things get interesting, which we'll expand on Friday as well, is this idea of the benefits and what we consider to be allowable deductions. Now, the salary is what it is. You get paid per hour, whatever is in your contract, same for wages. Now, bonuses, the first thing about bonus is that bonuses are taxed when they are received. So, for example, if we are in the year 14-15, and you're told that you will get a bonus of 15,000, and you receive the bonus in 15-16, you receive the bonus in 15-16. That's when the bonus will get taxed. So bonuses are taxed on receipt of the amount of money. Right, and that's kind of the first thing you'll see questions that will try and declare a bonus in another year, and you receive it in the year, but it is taxed in the year that you receive it. Receipt. That's the key issue here. Benefits, there's so many benefits that people receive nowadays, that if you like, the whole idea again was that they try to receive these benefits, they receive the benefit, and we then find a way of monetarily converting it or turning it into money, a money version, so we can then therefore call it employment income and therefore tax it. So you can see people who like to try and get benefits that they don't want to pay tax on. I've talked about this. First of all, this is to do with the bonus, and it is based on a receipt basis. And there are special rules for directors, but we'll come back to that later on in class, because directors try to manipulate when they actually receive these these bonuses. We'll come back and talk about that. Now, so if I just go back here, I'm just going to again talk about, before we talk about benefits, I'm going to talk about a couple of allowable deductions, probably just the one for this first session, just to get you into it, and then you can read up on the rest. So hopefully as you read it, when I talk about it again, it'll sort of confirm learning. So in terms of allowable deductions, probably one of the most popular ones is to do with travel, right? So anytime you go ahead and do any work on behalf of your employer, if you have to travel to that place to do it, that is an allowable deduction. If you catch the train, or if you fly there, take the bus to a client to do any work for them on behalf of your employers, then that is an allowable deduction. I say so, this is if your employer is not going to reimburse you the money. If you are just going to spend that money doing it, you are allowed to deduct that from, if you like, your wages for tax purposes, right? So here we are. So, but of course, just going to work and coming home is not allowable. So your ordinary commute to work is not allowable. But like I highlight here, if you visit a client and you had to pay for it, then such costs are allowable. Now, there's this other secondary issue about what's referred to as a temporary workplace. So, for example, you live in London and you normally go to work in you're in central London, and you live in South London, and you typically go to work in central London every day. And if you had to go to central London and come back as normal, that wouldn't be allowable. But if you suddenly had to go to North London to see a client on behalf of your employer, your journey to that client and back, if you like, is allowable. And I think if you also have to move to a city and work in that city and travel to do work for your employer in that city, a completely different city, that also would be allowable. What's considered a place of work is if you're there for less than 24 months, right? So all the travel in that time would be considered travel expenditure, allowable travel expenditure. This one I'll talk about. Whoops! Oh, that didn't come through. I thought I put that through. This is the only one I'm going to talk about because I try not to exceed the 10-minute sort of structure. But let me just go to my other slides because I had that on there. Right. Yes. What I'll do is I'll just bring these in because that's what I wanted to do anyway. Copy that and bring that in here. Yes, let's see, let's bring that in. Okay, right. So it's sort of saying what I'm going to sort of talk about. Again, other allowable deductions if you're paying into an occupational pension fund. I think I mentioned this right at the beginning of the video. That can be deducted. If you're paying to the ACCA or any other professional deduction, that can be deducted. Like I said, travel expenses incurred for the purposes, wholly and necessarily for the purposes of the business, that can be deducted. Payroll deduction scheme, whatever it is, gift aid, or when I say gift aid, any gifts, donations, things like that, that can be deducted. And this little special one here to do with mileage allowance. So what we have here is what's referred to as the approved mileage allowance payments. So HMRC have a little sort of table telling us that you are allowed to claim 45p for every mile or if you like, for the first 10,000 miles. 45p, and that is allowable, if you like. That's deductible. So you travel to a client on behalf of your employer, and you travel 5,000 miles. You can claim 45p on every mile of petrol that you use. And then once you get over 10,000 miles, you can only claim back 25p. So you can see the issue here is that it doesn't really matter if your employer gave you 40p for every mile you traveled. Say you traveled 5,000 miles, you can claim back as well. You can put through another 5p as an expense because you've already received 40p from your employer, but you should really be receiving 45p. You can claim back another 5p. If your employer, though, on the other hand, had given you, like, say, 60p for every mile traveled for the 5,000 miles, well, your employer has given you 15p too much, and that becomes a benefit to yourself. So you can see that this could really go either way. And I just sort of stated that where payments made to the employee are greater than the annual mileage allowance, the excess is assessed on the employee as a benefit. And when the payment to the employee is less, the difference is allowed against your employment income. So yeah, that's kind of what's going on over here, what they're sort of reiterating over here. And so this is another, again, we'll just do this manually very quickly. I'm on page, I think I'm taking this example from page 131. So this is from page 131, right? And what you will see here, right, is it says you have this guy called John who's traveled 12,000 miles. So what do? He's received 42p per mile. So he's gotten 12,000 times 42p. So he's received 5,040 from his employer. So what is allowable? Well, 12,000, well, I'll break it up, 10,000 and 2,000. 10,000 is allowed at 45p and 2,000 is allowed at 25p. And this comes to 4,500 and this is 500. So he is allowed 5,000 as an allowable expense, but he's received 5,040. So he has received a benefit of £40, if you like, because, because the what he received from his employer was much more. And if he had received 35p, I'm doing exactly the same thing, but this time I'm multiplying this by 35p. And if I multiply this by 35p, 12,000 times 35p, I'm going, 12,000 times 35p, I'm going to get 4,200. So he's only received this, he deserves this, so he can deduct £800, which is the difference, as an allowable expense. Cool, great stuff. So that's where I'm going to end it. And please read through the rest of Chapter 4. I will also send the PDF of Chapter 4 of the book to yourselves. And just have a go. And then I'll just come back, talk through it, and go through questions, and then plow on with 5 and 6. I hope to get through to 7 by Friday. So then I think 7 is on, the basis of assessment, and then make a video on 8 and 9. So we would be done with, if you like, personal tax, hopefully by this Friday. Okay, great stuff. Thank you.